Hi. Now in section 2, I will introduce demand forecasting and capacity decisions. This is very important in your business plan. So after you design the product, the next step is you need to think how to make your product. And you need to consider, how big your manufacturing facility, what kind of process, and what kind of menu purchase machineries, how to arrange them, its facility layout, and so on. All these operation issues depends on forecasting demand. So I will introduce forecasting demand first. It's very important human resources decisions. You need to hire, training, reliable workers. But when you hire your workers, how many people? How many manpower is required? How many manpower should be laid off? All these answers depends on forecasted demand. If in the next 2 or 3 years you expect the demand to continue to increase, you need to decide how many people should be hired every year, and when you need to start to hire, and how long it is required for training, and so on. And also the capacity. Capacity means how big your manufacturing facility is per annual basis. How many units of product should be produced in your manufacturing facility. So capacity is small, then you will face capacity shortage. Capacity shortage can result in undependable deliveries. Loss of some customers may move to another competitors. So and finally, you will lose market shares. And also, when you have forecast demand is high and increasing, your suppliers should provide all related parts and materials on time. If you want to produce more product, suppliers should provide more material parts on time. And also, when you develop the high quality and low price product, your supplier is very important to fulfill such missions and so on. And also, forecasting is very important when you prepare your next year's budgeting and so on. So, forecasting is 2 methods. One is qualitative forecasting method, and next one is quantitative. We have quantitative forecasting and qualitative forecasting. And the name terminology quantitative forecasting, they use lots of data. All previous data will be used. But quality forecasting, they use some information, the intuition, the understanding about the product. So qualitative forecasting method is very useful, and the market situation is vague. You do not know, or you have little data exist only. So example is when you develop a new product or new technology applied, then you do not know. When it's new product, is usually sometimes market may not exist. If you are the first innovative manufacturer, you develop totally new products. The market never existed before. So in this case, you have no data, so you cannot use quantitative method. And also, in the life cycle is like this. But introduction stages, we have very little data exist only. So, any product in introduction stages, you cannot use quantitative forecasting and so on. So, in this case, many people, they use intuition, or sometimes they experience such a qualitative method will be used in forecasting. There are 4 major methods are used in forecasting. One is jury of executive opinion, telephone method, Salesforce composite, and customers market survey and so on. The first one, jury of executive opinion, means you will meet a group of high-level experts, a high-level manager. So maybe 2 or 3 persons are meeting together like this. This high-level group estimate demand by working together. They have a good experience, they have good knowledge, they have their own managerial experience, and also sometimes if they have some statistical data of similar product or other previous data, but major product is they use the experience together. When you use executive opinion, is you can make a quick numbers, quickly you can get the focusing numbers. But problem is group think disadvantages. So high-level managers, it's very difficult to have a meeting. They are very expensive. Their time is very expensive. And also, among these 3 persons, 1 person is maybe the higher position compared to others. Then all others, they may not express their opinion correctly. So high-level jury of executive opinions is a very useful technique. But in the beginning, when there is few data available and so on. Second one is, instead of high level, you will have group thinking process. So we will invite someone who knows well in this. We will have some steps. Then we never call a meeting, but we will provide the questionnaires. Each participant is explain how many units can be sold next year. And then when each people explain their numbers, we will collect the data, and we will calculate the average and what is maximum focus demand, what is minimum, what is standard deviation, and so on. And then invigilator will give a feedback to each members. That each members will think again and again until we have consensus is reached. So through the Delphi method, everybody express their opinions. Everybody. The higher level jury of executive opinions, some people will not express their opinion. But in Delphi method, we never call the meeting. But it is, we will discuss using email and so on. Then each members will express their own ideas. And then when they have a feedback, they will iterative thinking about until they have a consensus. Delphi method is time consuming compared to high level jury of executives. Third method is salesmen, sales force, they meet their customers, so they have their own experience. Then each salesperson is easy, they can project how many units, how many service or can be sold next year. And then we'll combine all each salesman's focus numbers. And you combine, and then we will have whole focused demand. But this way, the objective and the basis is salesmen, they know customers want because they meet the customers regularly and so on. But this advantage is sometimes they tend to be overly optimistic. Each salesman, they will like to express, they are capable to sell more product next day and so on. Last method is who will know they will buy product or services? Consumers. Consumers will know whether they will buy or not and so on. So we will directly ask the customers about whether they will purchase or not, whether they have a purchase plan next year and so on. What consumers say and what they actually do are often different. But problem is customers' response in survey, but their final action is not very close. It's related, but sometimes it's quite different and so on. So sometimes questionnaire question itself is very difficult to answer and so on. So when you develop very good market questionnaires, then you can get a reasonable and reliable focusing demand from consumer survey. These four methods are useful technique in qualitative focusing. Next one is quantitative approaches. When you have some numbers, when you have historical data exist, and the previous data is shows some stable pattern of the demand changes, then it's very useful. Example is existing product, and you are using same current technology, and in life cycle with growth stages or maturity stages, then qualitative methods are very useful to be applied. But here, there are two groups. Time series model, you think is x-axis is time, y-axis is demand. Demand is a function of time, then it's time series model. Associative model means demand is a function of many factors. Is a function of time and other variables x1 and x2, such as probably demand is a function of population. Demand is relating price index and so on. And GDP also is an important variable to determine next year demand and so on. The last one is associative model is linear regression. Regression is very useful technique in associative model. Or the first four is time series model. Naive approach next year time period T focus demand is previous T minus 1 period. Last period actual demand is considered as next period demand. Moving average is recent end period average is counted as moving average. Moving average is used to focus next period. Weighted moving average, we will use different weight. Most recent is a higher rate. 2 period earlier is a less rate, and 3 period earlier is a much less rate will be applied. Then weighted moving average may show recent trend compared to moving averages. Single exponential is new focusing demand is previous focusing demand plus some the last term actual demand minus focusing demand is this is focusing error. Focusing error multiplied by some constant between 0 to 1. So the second term is this is correction. Previous focusing plus some correction will be counted as new focusing demand. It's called exponential smoothing method. Or this method is some example of how to apply quantitative focusing and so on. And the next step is double exponential smoothing. Double exponential smoothing shows exponential smoothing focus numbers plus trend. Smoother the trend is will be used here. The concept is for exponential smoothing focusing and smoothing the trend is calculated, and then to add up these two numbers to focus the next year focusing demand. Multiple regression like this. Here x1 is maybe GDP, x2 is population, maybe x3 is price index. Using previous data, and we will find out what is slope of each variables. If you find out this is such a reliable regression formula, it will be used for focusing next year demand. Then, once we have focusing demand, then we will decide how many units should be produced next year. Okay, so it comes from focusing demand. the next decision is we need to decide how big the facility should be. So it is called capacity decisions. This capacity decision needs heavy investment in fixed asset. To build up a very expensive high capacity, you need to buy lots of expensive machineries. So we need to handle carefully about these capacity decisions. Break-even analysis is a very simple tool for capacity decisions. So let's say P is price per unit, Q is the unit of your production, then P times Q is equal to total revenue. Okay? Total cost is F is fixed cost. Fixed cost, V is variable cost per unit. So variable cost is direct material, direct labor, and other utilities and so on. So to produce more and more, you need to variable cost will increase and increases. So variable cost per unit multiplied by Q plus some fixed cost, then it is called total cost. Then total revenue minus total cost will be total profit. Then P minus VQ minus F. So P minus V is contribution margin. Contribution margin means when you sell one unit at P price, variable cost is V. So CM, contribution margin, is when you sell one unit, how much dollars you will earn from the sale. Minus F is total profit. Break-even means total revenue will be equal to total cost. So it means break-even, the profit will be 0. Then 0 is P minus V, Q minus F, then Q star. So the break-even point. The break-even point is fixed cost divided by contribution margin. This is called a break-even point, break-even quantity. This is break-even quantity. Graphically, when you see the x-axis is quantity Q, x-axis quantity, y-axis dollars. Then this line shows revenue line, y equal to P times Q. P is a slope. And this line total cost. So y-intercept is F. So this line is y equal to fixed cost plus variable cost times Q. The slope is, this slope is V. This is V. This slope is P. Okay. So when total revenue, total cost is meet here, this break-even point. So the selling price is 20, and let's say fixed cost is 42,000, and variable $14, and Q is 7,000. So 7,000 is break-even quantity. Break-even quantity 7,000 units. When you see this one, if you sell more than 7,000, you will have profit. So this means when you sell 10,000, you will have this much profit. If you sell with 4,000 here, the difference, this is called loss, net loss. This losses, this is profit. So this break-even analysis, if you have two options in capacity decisions, one is F1, lower F1, the second line is higher F2. Okay? Same revenue line, but different cost lines. If you invest more in fixed assets at the beginning, break-even point will be bigger. Break-even point will be bigger means if your annual demand is lower than break-even point, so it takes much longer time to break even. If you invest less amount in fixed asset, you will meet break even earlier. So this analysis is very useful when you consider different capacity. Capacity 1 at fixed cost here, second capacity is fixed cost 2. The break-even point is different. But problem is, if you pass over the break-even, when you continue, you find it like this. If you invest less, 2 or 3 years later, you may earn less profit. If you invest more at the beginning, you may have more profit in long run. So, capacity decision is totally depends on your forecast demand. Your forecast demand is much bigger than this break-even point. You may select higher capacity, or your capacity and forecast demand is not very bright. It's better to choose lower capacity. Okay. At bottom is I have explained effect of fixed asset. More fixed asset is more return if you will sell more than break-even point, but you will face losses if you sell less than break-even point. So it means high risk, high return. So when you invest more here, you will face high risk, high return. The capacity decisions it is required from reliable forecasting demand, and also you need to check your financial resources, how much your cash is available, and also your operating leverage effect. And check break-even point and your forecast demand, and then you need to find out related profit losses as acceptable or not. Some companies they choose lower capacity at the beginning, smaller F1, and after passing over the break-even point, and then they will increase capacity like this. This is increasing of capacity. Then when you increase capacity, fixed asset will increase. You will face another break-even point. So whenever you increase your capacity, you need to evaluate new break-even point, and when you will meet the break-even point, and so on.